As of today, I'm earning $1,075 per year through my dividend portfolio. I'm far from financial freedom, but this milestone has me very motivated and ready to invest more over the coming years. I want to show you around my portfolio, tell you a little bit about the companies I'm investing in, and talk about the strategy I'm using to drive my stock picks. My portfolio's total value is about $24,500 split evenly between a Roth IRA and a traditional brokerage account. I use Charles Schwab as my broker, mostly because this was the account my grandpa set up for me when I was a kid, and I also like the income tracking and projection charts, which is missing from a lot of other brokers. My current projected dividend income for the next 12 months is $1,072 with an additional $3 of interest income. This gives my portfolio a total yield of 4.36%. As a whole, I'm up 16.6% in my traditional brokerage account and down 0.8% in my Roth IRA. Let's take a deeper dive into each account and highlight some of my best performing and worst performing picks. By far, my best performing stocks in my traditional brokerage account are NanoExplore, Southern Company, and General Mills. NanoExplore is a graphene manufacturing company I invested in about 5 years ago when I first started to learn about the wide applications of graphene in tech and material science. At the time, graphene hadn't hit the market in force, but has exploded since then. I'm currently up 126% on this stock. Since NNXPF doesn't pay a dividend and I'm up so much, I'll likely sell this stock soon and trade it for a dividend-paying company to boost my income. Southern Company is an energy provider in the southeast part of the United States and owns Alabama Power, Georgia Power, and Mississippi Power. They serve over 9 million customers in this region. I bought Southern Company close to 15 years ago and I'm currently up 127%. Southern Company pays a decent dividend of about 4% and their current dividend growth is trending at about 3% per year. Although I might not buy Southern Company at the current prices, my yield on cost is about 8.5%, so I'm going to continue to hold it. Last is General Mills. General Mills sells many food products you probably buy every day, mostly cereals and other grain-based packaged foods. GIS was another stock I bought over a decade ago and have been simply holding and enjoying the cash flow. My yield on cost is about 5.1% compared to their current yield of about 3%. I haven't seen the snowball fully start rolling yet, but in another 10 years, this stock will produce some decent income. General Mills did cut their dividend back in 2010 and only maintained their dividend between 2017 and 2020, but still have a dividend growth rate of over 3% over the past 10 years. I'm currently up 63% on this trade. The losers in this account are definitely AT&T and Uranium Energy Corporation. I've owned AT&T since mid-2010 and enjoyed the dividend and share price growth right up until their dividend cut in 2022. This has cut my yield on cost down significantly from about 10.7% in the beginning of 2022 to 5.7% after the cut. I'm unsure about the long-term outlook of the company, so I might be selling this stock soon. Uranium Energy Corporation is a uranium mining company with properties in Texas, Wyoming, New Mexico, Arizona, and Colorado. The idea with this play was similar to that of NanoExplore, except the investment hasn't paid off. Today I'm down almost 19% on this trade. I'm still optimistic about the future of nuclear power, however, so I'm going to continue to hold in the hopes that uranium ore increases in price substantially in the future. The clear winners in my Roth IRA are US Bancorp, Coterra Energy, and CareTrust REIT. US Bancorp is a personal and business banking company with a 13-year dividend increase streak. I actually found this company while looking over Berkshire Hathaway's SEC filings and found it was one of only a few stocks Warren Buffett has been holding for more than 10 years. The current yield is about 5%, but when I bought the stock, the price was way down and the yield was closer to 6%. Their 5-year average yield is about 4%, so even at today's prices, it looks like a good deal to me. We did a video analyzing USB, which you can watch by clicking the link in the description. Due to the massive increase in share price over the past few months, I'm up 26% on this trade. Coterra Energy is an oil and gas mining company based in Houston, Texas. They own several properties throughout the United States and sell these commodities to suppliers across the country. I bought CTRA at a steal back when their dividend yield was close to 9%. The drop in share price was mostly due to the drop in energy prices over the past year, but the fundamentals of Coterra are sound. They've been paying an increasing dividend for 7 years, which isn't the longest streak, but their payout ratios and income growth are stellar. Most of my gains have come from modest bumps in share price, but the healthy dividend distributions have also helped. I'm currently up 8.2% on this trade. Last is CareTrust REIT. CareTrust REIT is a real estate investment trust that focuses on owning urgent care, nursing, and assisted living facilities across the United States. Not only was CTRE's dividend fundamentals solid when I got in, I also anticipate the need for assisted living facilities to increase as our population ages, which will drive up the value and income of their portfolio. CareTrust REIT has been paying an increasing dividend for 9 years and their 5-year average yield is about 5%. I'm currently up almost 11% on this trade. The biggest losers in this account are definitely UGI Corporation and Zim Integrated Shipping. UGI is an international energy distributor. They own natural gas distribution pipelines, LPG pipelines, and also sell propane through their AmeriGas subsidiary company. UGI's huge drop in share price is what's killing me here. They've been paying an increasing dividend for 36 years and their payout ratios are very safe, so I don't think they're about to cut their dividend. The price of the commodities they sell has been dropping and I think the market is reflecting that in the share price. I also own UGI in my traditional brokerage account, but bought in at a much lower price than in my Roth. Honestly, I'm happy with the drop in share price right now as it means I can buy even more shares with my dividend reinvestment and additional capital. Over the long haul, I believe this stock will be a good pick, but right now I'm down 19% on this trade. Zim Integrated Shipping was a bit of an impulse buy, I'll admit. Zim came up in one of my top yield dividend stock videos and I like their method of providing shipping services. They basically rent vessels and supply the crew so they cut down on maintenance costs and can easily scale up or down with demand, which is unique in the shipping industry. Over the past few months, however, Zim has revised their earnings outlook and many investors are fleeing the stock. My cost basis in Zim isn't that high, only $300, and I like the exposure to the shipping industry, so I'll hold on to the stock for now despite being down 12% on the trade. My current dividend analysis strategy is twofold. First, I look at the income a stock is likely to produce by reviewing initial yield, trendline dividend growth, and expected share price appreciation. Initial yield and trendline dividend growth are easy to calculate, but share price appreciation is a little harder for me to determine. Most of the time, I look at the historical growth of the stock and some general market factors that influence share price and make a conservative assumption between 0 and 10%. With these metrics, I can project what my dividend income might be 10 to 20 years from now. I typically want to see average annual returns greater than 10% and yield on costs greater than 20% after 20 years. I also look at dividend safety by analyzing a company's payout ratios, financial growth, and dividend increase streak. I calculate payout ratios by dividing the total dividends cash flow from the statement of cash flows by the net income, operating cash flow, and free cash flow over the same time period. I'll do this on both a quarterly and annual basis, but I typically just look at the annual calculations. I'll also take a look at trendline growth on net income, operating cash flow, and free cash flow. I want these financial metrics to trend up at least 3% per year and normally use a trailing 12-month model from quarterly financial statements. Lastly, I'll look at the dividend increase streak for the company. Ideally, this streak is greater than 10 years, though I fudge on this threshold if the other metrics are solid. If a company meets most of these cutoffs, I'll probably buy the stock if I have extra capital. Having these limits helps me stay disciplined in my investing and makes me more comfortable buying a stock knowing there's some data to back up my decision. I'm still deep in learning about dividend stock analysis, so this method is likely going to change as I progress and get better at reading the market and evaluating specific companies. I'm going to post updates on my progress like this one on a monthly basis, probably close to the end of each month. I'll summarize how much additional capital I've been able to save, some of my top performers, and stocks I've bought and sold since the last update. If you want real-time updates as I buy and sell stocks, click the link in the description or the pinned comment to get a free spreadsheet of my full portfolio. I continuously update this spreadsheet as my positions change, so you'll always know what I'm invested in. I'll also send you buy and sell alerts when I'm getting ready to make a trade. I can't always post videos about deals as they happen, so this is the best way to get notified when I see an undervalued stock on the market or when I think a dividend stock is doomed. Thanks so much for watching. As always, stay safe and take it easy.